At the moment, this is a market that's trying to figure out how much tightening will result from the run on the banks we saw over the past month. How are you thinking about that?
Well, I think, specifically on the banks and monetary policy, what we've seen globally is the governments and the policymakers really trying to split these two things and saying we have, really aggressive policies to deal with any issues in the banking sector. And we have aggressive policies that are separate on the monetary side, i.e. hiking rates to deal with inflation. And so far they've been kept separate. And as you've said, the equity markets, have taken a very benign view of what's happened this week. Although, of course, in the bond market and maybe in the currency market, it's been a little different.
Does it make sense to you then, or rather not does it make sense because you explain why it's happening, but can stocks continue to defy gravity? Can they continue to climb if we do have such opposing views being played out in other markets?
Well, yeah, I mean, as you say, you wouldn't see you wouldn't see the crisis in the equity markets, but you are seeing it elsewhere. So, in our view, we think that the risk reward on equities is not necessarily fantastic here, and we would increase our allocation to fixed income. And one of the reasons for that is because what we're seeing is that because of the banking issues that have happened, probably some of the smaller lenders, particularly in the United States, are going to pull back on some of the lending they do. And that's very important to credit creation in the economy. And we haven't seen that come through yet. So we think it'll come through, and it'll start to come through in earnings, particularly in banks, but also in broader measures.